You're watching a NAS100 trade sweep into a deep market dip, catch the absolute bottom, and ricochet straight up to its profit target. Standard volume bars at the bottom of a chart record activity by time. Volume Profile shifts that data to the y-axis, showing you exactly which price levels attracted the most orders during the session. By overlaying this horizontal volume map with specific candlestick gaps, we can isolate the price points where the market is most likely to stall or reverse. You don't need expensive software for this. A basic TradingView account and a standard NAS100 chart are the only tools required. Without this spatial awareness, it is difficult to see where institutional money is resting. You are forced to guess at support and resistance based on candle wicks alone. Mastering this map allows you to identify specific price levels where large orders were previously filled, providing a clear structure to the chart. Step 1 is getting the map on your screen.
Open your Indicators menu, search for Session Volume Profile HD, and click Apply. Inside the settings, turn on Value Area High, Value Area Low, and the Point of Control. Give each a distinct color. Next, adjust the total value area to 70%. Finally, check the Extend Right box. This ensures our volume levels project out into future price action. This is a visual map showing exactly how much volume was traded at every price level. The absolute longest bar on this profile is your point of control. This is the price where buyers and sellers reach the highest level of agreement. The thick, clustered peaks surrounding it are your high volume nodes, where price tends to linger. Notice the deep dips and empty spaces between the peaks. These are low volume nodes. Because very little trading happened here, these areas often act as magnets or rejection points for price. We are going to look past the high volume peaks. Our strategy focuses on identifying entry setups inside those empty, low volume spaces. Before we look for an entry, we need a directional bias. First, establish a clear, overarching uptrend on your NAS100 chart. This chart shows a distinct upward swing. Pull out your retracement tool and measure from the bottom to the top. We are only interested in taking a trade in the bottom half, below that 50% midpoint. Now look closely at that lower zone. We want to find a horizontal line extending outward from one of our empty low-volume nodes, cutting directly through this discount area. This is where we wait. Watch the price action pull back, drop below the halfway point, and make contact with that extended low-volume line. This sharp drop into an empty space flushes out retail traders. They sell into the imbalance, providing the liquidity required for institutional participants to step in. Do not buy simply because price touched that low-volume line. Entering blindly on a touch is a common error. Instead, we need a trigger. Look closely at this 3-candle sequence. As the price pushes down into our volume node, watch for the first candle's low and the third candle's high to separate, creating a standard bearish fair value gap. Here is our trigger, the inverse gap. We wait for a sudden, aggressive upward candle that completely overtakes that previous bearish gap and closes above it. That energetic candle close above the gap confirms a shift in local momentum. It shows the bearish pressure has been neutralized by buyers. Once that candle closes, execute your buy order precisely inside that newly inverted gap zone. Anchor your stop loss just below the lowest point of the recent dip. Then, set your take profit target at the nearest high-volume peak above your entry. The inverse fair value gap provides the mechanical confirmation we need. It signals that buyers have stepped in to defend the empty volume space. The trade executes. Price launches away from our entry zone, traveling through the empty space, and striking the take profit target. Let's review the framework. Step 1. Identify your overarching NAS100 trend and measure the lower retracement zone. Step 2. Locate an empty volume valley extending into that zone and wait for the price to drop into it. Step 3. Pull the trigger only once a bearish candlestick gap inverts and closes upward. Open your charting software right now. Apply the Session Volume Profile HD and start mapping these low volume zones. By mapping the spaces where volume was thinnest, you move away from reacting to every price movement and toward executing a structured, mechanical strategy.